I have 10 rules for investing in the stock market. I call them my 10 essential rules. In fact, you'll notice I've got my book here that's all about that, and it tells you in a lot of detail about these 10 rules. Rule number one had to do with fundamentals and how you should use fundamentals in your decision-making process for picking the right stock at the right time. Rule number two has to do with value. And I know that there's a lot of value investors out there. Perhaps you're one. And one of the things that I believe about being a value investor is that if you focus solely on value, you're probably going to get yourself hurt in the stock market. There's a thing out there called a value trap, where it looks like a stock has become, or a company has, its share price has gone down so low, and the company is so strong that you will buy that shares in that company just because you believe the value is so great. But that doesn't make the stock's price go higher. Value does not move a stock's price higher. What value does is to tell you really whether or not you're getting a good deal on your purchase of shares or not. I'm going to get into some detail about that in just a minute. But keep this in mind. There are some great value investors out there, Warren Buffett probably being one of the best ones that's out there. But very few people have enough money to be the kind of value investor that Warren Buffett is. And a lot of times investors fall into a trap themselves of thinking that if they buy value that they will be safe. And that does not happen. Many, many times you'll buy a stock because the company is such a great value, but your share price goes lower and lower and lower, or perhaps over a long period of time, those shares don't go up at all. And after all, why are you in the stock market? You're in the stock market to make money. You know, I like to talk about collecting things as an example. And I use my wife often when I talk to large groups of people about how she's a collector. She likes to collect cookbooks. She collects all kinds of cookbooks. Now, we don't do a lot of cooking at our house, but we have an enormous number of cookbooks. And she enjoys that, and there's nothing wrong with that. You can be a car collector, a coin collector, an art collector, or you can be a stock collector. And being a stock collector is okay. But the problem with being a stock collector means that you really are collecting the stocks because you think they have great value, not necessarily because the price is going to go higher. I'm in the stock market to make money in the stock market, not to collect stocks. And you need to decide whether you are a stock collector or whether you are an investor who's looking to make money in the stock market. So here's how I use value, if you will. And I have one small test, and it has to do with the PE ratio. If you've got two stocks, you're trying to decide between the two, and after all, isn't that what we do all the time? We're looking out there at the stock market. There's 6, 7, 8,000 stocks that we might even consider, but we need to narrow that down to the one or two that we might want to buy. And sometimes you'll come down with two stocks with everything else being equal except their PE ratios. Now, when that occurs, you want to take the one with the lower PE because that's going to give you the higher value. But I would never make the decision solely on PE. And by the way, there's one other little very strong, very important element of PE ratio. Never look at the PE ratio of the stock compared to the average S&P PE. Only compare the PE ratio of your stock to the stocks in that stock's peer group. In other words, only compare the value of the stock you're looking at with the overall value of every other stock that's in its peer group. So rule number two is consider PEs, but only consider them from the standpoint of making a final decision as to which stock you might want to buy when you're trying to compare between one stock or the other.